One of the cool things about documenting my portfolio on YouTube is we can all go back and take a look at what I was doing many months ago, and at this point, years ago, to see what the portfolio looked like and what I might have been thinking when I was putting it together. Because if we look at my portfolio right now, I'm all the way down to 9 holdings, and this is very different than where we were before. If we go back to one of my earlier videos, here's one right here. This was episode 5 of the series, so the 5th month. I believe I started this in February, if not January of 2020. So right before the big crash of March 2020 is when I started this portfolio, which was kind of funny timing. But this is sometime after that sort of initial crash. But you can kind of see what we were working with. First off, the portfolio only had about $16,000, and I include a link to the portfolio in every single episode, and it should be accurate to what the approximate holdings were at that time. If you click on that link, and I try to update it every video. If there's a mistake, I apologize, but that's the goal here. But if you click on that link showing my M1 Finance portfolio, or at least the weightings that I assigned to each of the holdings, you can take a look at the total number of holdings and everything I was working with. 95 holdings. 95 different individual stocks were in this portfolio, which only had $16,000 at the time, as we saw. So a very small portfolio relative to where it is now, chopped up into 95 different pieces. And even within those pieces, see 45% here was this Ben Felix inspired portfolio, which is just broad index funds. So many tiny little slices from there, if you want to look at it that way. So it's extremely diversified in that sense, at least compared to where we're at today, within this kind of Joseph Carlson fund, which was actually a direct copy of what he was working with at the time, since he shared his own portfolio too. And that was kind of an initial inspiration for this series, since he has a really great channel and he shows his portfolio and what he's thinking through building that portfolio and different stocks he's looking at. So kind of taking some inspiration from there. And his series was one of the big catalysts for launching this series. And it's been cool to see him grow as an investor as well, since things change through time. And interestingly, Joseph Carlson at the time was also quite a bit more diversified than I think he is now. I think he has far fewer holdings, or at least he's far more concentrated into fewer holdings than he was at this point. Got 48 holdings just within this copycat portfolio of Joseph Carlson's portfolio at the time. So this would have been back in early or mid 2020. Whatever the case, this portfolio was very diversified, and I really was not doing any sort of individual research, at least on any significant level, towards any of these holdings. It was more of a shotgun approach to stock investing, just trying to buy a bunch of everything and seeing what sticks, which is really sort of the thesis of using index funds, in that you're buying the whole index. So you're going to have a lot of stocks that go down in the index. You're going to have a lot that go up, and ideally the ones that go up outweigh the ones that go down, and you're catching all those big winners. Even if you have a bunch of losers, the big winners sort of pull the whole index up. That's the idea, at least. And that has worked very well historically. But if we go back to my current portfolio, it looks very different. As I said, we only have 9 holdings in here now, so very concentrated compared to where we were before. And the only thing that's sort of like an index fund would be Berkshire Hathaway. It has a lot of diversification built into its own holdings. Granted, they're pretty concentrated into just a few holdings, so it's not the same as a broad index fund, but it has a lot more built-in diversification than some of these other holdings. And over the last couple of years of doing this series, you've seen me consolidate down to this far more concentrated portfolio. You've seen me change my approach as a stock investor, as an investor in general. And that's because I'm always trying to learn as an investor, and that might require me to change my approach if I think that something would potentially work a lot better than what I might have been doing in the past. And that's really the whole point of learning. You learn from either your mistakes, you learn from other people's mistakes, you learn from other people's success, your own success. There's always tons of things that you can learn, especially this early on in my investing career. I'm really only a few years in of really seriously focusing on investing with any significant amount of time. So the point is, there's definitely still a lot to learn, and I'm going to continue learning for many years hereafter. But for now, I've gotten to the point where my portfolio is way more concentrated. I'm investing in things that I feel more comfortable in on an individual basis, rather than just blindly investing into tons of things. Granted, I do still have plenty of index funds in my retirement accounts, so my IRA, my 401k, my tax advantaged accounts. Those are far more diversified, and I see those as a potential safety net against my own potential stupidity. Though there's no guaranteed result in any approach. And this definitely is not to say that my approach would be the best for everyone. It might not even be the best for myself. There's plenty of things that could go wrong with this. Every strategy has its own potential benefits and potential risks. In this case, because it's so much more concentrated than before, if any one holding does poorly, then the rest of the portfolio is going to be more adversely affected by that poor performance. But on the flip side, if something does well, the exact opposite is true. That is, if something outperforms by a wide margin, then that's going to pull the rest of the portfolio up more than if I was more diversified and you sort of dilute the effects of any one stock. But there are also some significant things that have changed outside of this portfolio since I started the series a couple years ago. I'm making a lot more money now than when I first started the series because I was still in law school at the time, so I had at most a few $100s per month to invest in anything. I also had fewer real estate holdings at the time, and I didn't have the business that I recently closed on in Houston, the small business that now makes up really the vast majority of my stock portfolio if you were to count the book value of that business based on my own purchase price. And all of this is to say that the incentives that drive my decisions for running my portfolio have changed simply because the risks are in different places, or at least the amount of risk has changed relative to where it was when I first started the series. And that's on top of all the things that I've learned about investing in the meantime. And I do think I'm going to continue going down this route of concentration in the coming months, and I think I'm going to continue consolidating my holdings, at least until I have a lot more money to invest, and I think it would make more sense to diversify at a greater level to try and spread the risk a bit more, because I would have more at risk in the first place. But all of that said, here's a quick performance review from the last month. We're up about 4.7%. I will say that I'm filming this a few days early because as of the release of this video, I expect to be in Dubai for fellow YouTuber Karan Gurnani's wedding. He graciously invited me and I was happy to accept, but I wanted to make sure I still got this video out on the 15th as I do every month. So if the market did something crazy over the last 2 days, it won't be reflected here. But either way, let's congratulate Karan in the comments below. But barring some crazy market action, we saw the biggest move in the portfolio with Meta. That was on their earnings that were really, I didn't think that surprising, but the market really loved it. So it has surged over the last month, nearly 31%. We're actually green on that holding. The stock's at 174 while my cost basis is at 173. So we are officially green on that holding for now.
On paper.
But we'll see what happens with Meta stock over the next few months or really years. But otherwise, the biggest change in this portfolio was that I sold off the covered call ETF that I had on the S&P 500. I sold that and rolled that all into Seritage Growth Properties. So that actually makes it technically my largest holding based on the actual value of that stock right now. Or at least I should say the price times my shares. What the actual intrinsic value is up for you to decide. And we'll keep an eye on that one as they continue to move through their liquidation process, selling off all their properties, paying off their debt, and ideally they'll have a nice cash pile left over that can be distributed to shareholders. So if you want to make sure you don't miss future updates, be sure to subscribe. I put out a new one of these episodes every single month. But until next time, thanks for watching.